President-elect Donald Trump's proposed tariffs could have a slower rollout than expected. That's according to a Bloomberg report, which says his advisors are discussing using emergency powers to gradually increase tariffs each month. Joining us now is Marko Papic, the macro geopolitical chief strategist at BCA Research. And Marko, it's great to have you on, so welcome.
Same, thank you.
So I want to start right there with this report, because we've seen some other reports about tariffs, and we've actually seen the president-elect bat those down. But this report moved the markets. And I just want to get your thoughts on this, because on Thursday, we've got Treasury Secretary nominee Bessent in front of the Senate. And there is this focus and concern, perhaps, from corporate America about what the tariff rollout is going to look like. 2 to 5% per month doesn't actually sound that low or gradual to me.
It isn't. It's not low or gradual at all. It's actually been originally proposed by Stephen Miran, who is an economic advisor to President Trump, in a paper that anyone can download online. And it argues that this is a way to sort of allow the market to digest the tariffs. But also in the same paper, there's a suggestion, which is an obvious one, that it could also allow for negotiations. So instead of going straight up to 20%, there's a timetable that doesn't actually just help corporates or the markets, but actually helps the rivals of the U.S. understand that there is a time frame during which they can come up with some solutions to supposed President Trump's demands.
What would actually be potentially more inflationary? Gradual tariff increases or a one-time blanket application across the board?
Well, I actually am in agreement with most of President Trump's advisors in that I don't actually think tariffs will be that inflationary. There are currency effects that will, give away, that will allow for some of those tariffs to not really have a massive inflationary impact. So that's the first thing I would say. And I think inflation will also depend on a slew of his other policies. Far more inflationary than tariffs, in my view, would actually be tax cuts. And the widening of fiscal deficits. That would probably add growth that the U.S. doesn't need. But tariffs themselves could either be netted out by currency or could actually be disinflationary if they lead to less investment domestically in manufacturing as other countries retaliate, and just generally less global growth as well.
Okay. So, Marko, first 100 days of the Trump presidency, what's going to be the most investable either action or lack thereof that you're watching?
So I think that right now, I'm in the camp that believes tariffs are a tool of negotiations, not an end in themselves. However, I do also feel that I'm pretty much in a very much sort of consensus camp. Everyone's come to this same realization, and that does worry me. I think that the U.S. dollar will probably have more upside, and global stocks will probably have more downside as President Trump gets serious about implementing tariffs, and he has to. He has to, because in order to use them as a tool of negotiations, everybody has to believe they're not a tool of negotiations, that they're here to stay. And so he has a really huge interest in being pretty severe early on in his term. So that's the first issue. The second issue is that I think we're spending too much time on tariffs, not enough on fiscal policy. And I think that actually a big surprise for investors over the next 3 to 6 months is going to be that President Trump is not going to be allowed to spend as much as he planned. So deficits are not going to widen as much because the bond market will continue to put pressure. And so I think at some point in the maybe later first quarter, second quarter, there'll be a bond buying opportunity and a dollar selling opportunity. We're not there yet, but I think that's going to be like a second quarter moment.